tradeschool.com, and this is lesson number 3 in our video series, and I want to just take this moment to clarify that the stock market is always changing, right? So even though I'm going to show you some stocks, because this is the third lesson in the series on how to invest and how to begin investing, remember the market may change. You don't have to like any of the stocks that I'm going to show you, but I am just going to show you how they benefited both me and my students here at WI Trade School and how I help them grow their wealth. But I just want to do a very quick recap. We've covered in part 1 why you should be investing in the stock market. Don't be afraid, intimidated. Just keep everything simple. 2, we talked about using margin and growing wealth for the longer time, and opening an online trading account and where you should do that. So I know you are ready for the next part of the series, which is choosing good stocks. So I have this wonderful saying, as I like to really keep things simple, that a picture is worth 1,000 words. So I'm going to show you some stocks, and I'm going to show you something looking at what we call the long-term trend in the Wealthy Investor Program. And long term for us basically means 5 years. You see this 5Y here? We could look at a 10-year chart, we could look at a 2-year chart, but for us to determine trend, we want to look at a 5-year chart. So this is a 5-year chart of a company called Apple. Most of you know, ticker symbol AAPL. And notice that the stock is not going straight up. It has some volatilities. That basically means some highs and some lows, and it has a tendency to go down and then rise. Now, most of my students don't like this picture for their long-term investing. It's not terrible, because if you look down here, 5 years ago, you could have picked the stock up at around $53, and it's hit a high of about 130, and then it's pulled back to where it is at the time of this recording, which is around $98 a share. So had you purchased the shares, let's say back down here at $53, would you still be happy if the shares are around 100? Yes, but I know what you're going to say. Tyrone, I was happier when they were up at $130 a share. So this is Apple, ticker symbol AAPL. Now be patient here, because I'm going to show you a methodology for choosing stocks that works over and over and over. I'm going to pick another company here and look at that 5-year trend, and this company is ticker symbol MCD. It is known as McDonald's, the McDonald's Corporation. Surely you know them. Ba-da-ba-ba-ba. Okay, here we go. If we look at the stock here about 5 years ago, the stock was around $85 a share. If we follow it, we see this volatility here. We're talking about, in this particular instance, holding the stock for 5 years, and then out of nowhere, an upsurge, and the shares are now around $128. So we started 5 years ago down here at 85, and now they're up to $128. Would McDonald's have made a good investment for you? Well, it could have, as long as you were willing to be patient over 5 years to have this increase in the stock price. See, this is what wealthy people do over and over. They take established names, established companies, which I'm going to get to here right now, and they invest in them. When you're a shareholder in McDonald's, not only do you get a dividend, but you own a small piece of the company. Now, here's something that I really want you to consider, and a lot of people fight me on this. It's okay. It's your money. It's just that I teach people how to make a lot of money, so you may want to keep an open mind and listen to what I have to say, because this next part's really important. This is the chart, 5-year chart of McDonald's. This is a 5-year chart of Apple. This is a 5-year chart of another company that you might be familiar with called Amazon.com. Ticker symbol AMZN. Now notice, if you bought this stock 5 years ago when it was at $193 a share, it has just gone up higher and higher and higher and higher. Had a little pullback here. This is called a pullback, by the way, and what is followed is something called retracement and then a breakout. Imagine, we're talking about holding these stocks. Would you be happy today with the shares at $744? Now, what is interesting about these companies is Amazon.com, McDonald's, and Apple are all members of something called the S&P 500, the Standard & Poor's 500. To keep it very simple, they are part of a group that is the largest companies in the U.S. stock market, the top 500. Apple and McDonald's are members of what? The Dow Jones Industrial Average. Those are the top 330 stocks that combine and create this index called the Dow Jones Industrial Average. So, what do we do at Wealthy Investor Trade School when it comes to investing? We invest in Dow stocks and S&P 500 components that are in very strong uptrends like Amazon.com. When you're investing in a stock, you're willing to hold it for a longer period of time and let the stock price appreciate. Had you done that with Amazon.com, bought the shares at 193, and now here they are at 700, you'd be profiting handsomely each time the stock rise. Now let's go back to lesson number 2 about margin. Imagine if I owned these shares and I had that line of credit, which is margin. Now, I just want to say here, because some of you are going to leave comments, margin is not right for everyone. Not everybody wants to use their broker's money to make money. Not everybody wants to use leverage. They don't like the idea of using leverage. But I'm just telling you, the wealthiest people in the world use leverage. Well, if we just stay within the S&P 500 and members of the Dow Jones Industrial Average, McDonald's or Apple, and I'm not recommending McDonald's at trade school right now, I'm just using this chart for illustration purposes only, okay? Then we lessen our risk and we increase the probability that the money that we invest is going to go higher. See this 5-year chart of McDonald's? When you're investing money, you're always putting it at risk. What you want to do is lower your risk, right? And increase the probability that your stocks are going higher. So what is it that some people do? They go out and buy no-name penny stocks and they hope. We call that buy and hope that their stock price would rise. Why would I do that when there are these guaranteed members of the Dow Jones Industrial Average, Apple, and of the S&P 500 that Wall Street likes and that the big institutions are putting their money behind? You see, now we're into investing strategies and which stocks should you own. And most people don't know. That's why they wind up subscribing to Wealthy Investor Trade School, so that I can explain to you what's going on in the Dow Jones Industrial Average and in the S&P on a weekly basis. It just helps you choose better. Okay, so we talked about investing in the Dow Jones Industrial Average and the S&P 500, and I want to show you another picture because sometimes on Wall Street they say investing is so difficult, and it's not. This is a company called Pandora Media. You know them as Pandora, the subscription service. Well, look at this. 5 years ago, had you bought the stock price at $10 a share, it ran up to 37, and then what happened? A severe pullback here in Pandora. Now, I just want to show you something here in Pandora because this is really important. Pandora is not, I repeat, not a member of the Dow Jones Industrial Average and not a member of the S&P 500. You see, once you open your online brokerage account, it's very, very easy to just start picking stocks for the fun of it. But what I want to do, and what I always want to help you with, is choose better according to a methodology and an approach. So for those of you who are asking, here we are at lesson 3, Tyrone, how do I start investing? First of all, as I said in the first couple of videos, you start small. You don't take a lot of money initially when you become a self-directed investor. You start small, okay? And then you start with members of the what? Dow Jones Industrial Average, like Apple, members of the Dow Jones Industrial Average like McDonald's, and members of the S&P 500 like Amazon. And you stay away from stocks that are not members of those 2 top indexes. Okay? There's some technical reasons why members of the S&P 500 and the Dow Jones Industrial Average also increase. That has something to do with money flow. It also has something to do with the size of the float. But again, those are strategies that I teach inside Wealthy Investor Trade School. But here's what I want you to take away from this video is that when we are first initially investing, guess what? We don't want to have a lot of our money at risk in no-name stocks. We want to keep them in members of the S&P 500, Dow Jones Industrial Average, and we want to stick to that, and that is called a discipline. Discipline is part of what makes your money grow because you're willing to do the same thing over and over and over. And as I told you at the beginning of this video series, I want you to remember, all wealth is taught. Okay, so we have some more in this series, some more videos coming. But for those of you who really understand the significance of investing in members of the Dow Jones Industrial Average and you'd like to see what it is that I'm actually trading, start your membership now at witradeschool.com, wealthyinvestortradeschool.com, and I will be answering your questions every single week because I teach in video format. Why? Because apparently a picture is worth 1,000 words. Do you see what happens when we keep trading and investing simple and we can use very easy language to describe the process of investing? That's what I like to do in the Wealthy Investor program.